In this video, I'm going to share with you all the details of what you need to know to begin investing in the stock market. I'm first going to explain what the stock market is and how it works. I'm then going to share with you the things you need to know before you begin investing in the stock market. And finally, third, I'm going to share with you a 4-step process I go through and I encourage you to go through as you begin investing in shares of companies that you buy in the stock market. My name is Randy Perez. I've been investing in the stock market for over 20 years as a stock and option trader. But first, what is the stock market? Here you see some information about a company that most of you are probably very familiar with. You may be watching this video on one of their devices and it's Apple. Notice in this top section here, shares outstanding, and this is in billions. Here you see the number of outstanding shares, the number of shares out there that people own, investors, traders like you. These people that own these shares are a piece of Apple. One thing that's interesting here is that notice over the past 10 years, the number of shares that are out there on the market to buy and sell, it's actually been declining. It's declined quite a bit. But this is the number of shares available for an investor or trader to buy and sell. You see, one way a company raises money is by selling shares or small percentage ownership to investors and traders like you and I. That's what a share is. That's what a stock is. You're buying a piece of ownership in that company. In this case, if you bought a share of Apple, you're buying a very small piece of the ownership or the rights of an owner in that company. So how do you buy a piece of this company? And in this case, Apple. Where here you see the 1-minute chart of Apple stock. Every time you have a buyer, you also have a seller. And here you're seeing the transactions by buyers and sellers. It's an ongoing auction. It's just done online instead of in person. Now we're actually a few minutes before the market opens here. You can see that even before the market opens, there's a lot of transactions in Apple. These bars here are 1-minute bars. Now we see the line here, that means nothing was traded that minute. But each one of these bars, or each one of these lines is equivalent to 1 minute. It shows where Apple stock was bought and sold during that minute. For example, right now, if you look at the far right, you see Apple's currently trading for $226.47. So if you are buying a share of Apple, you should be able to buy it pretty close to that within a few pennies. If you're looking to sell it, you should be able to sell it pretty close to that also within a few pennies. So every time this stock moves, that means a transaction just happened. Someone bought shares and someone sold shares. And now you see the market is now open, so there'll be a lot more activity. But this is people buying and selling their ownership or their investment in Apple. And the stock market is just where those shares are bought and sold. It's an easy way for investors around the world to buy and sell shares or ownership in companies like Apple. As you see, even over the 1-minute chart, the price of Apple goes up and down. I've now switched this chart to the daily chart. So each one of these candlesticks show the action for that day. I've now zoomed into August 5th. And notice what happened that day. The stock started trading when the stock market opened at around $209.28. Then at the end of the day, when it closed around 4 p.m., it was trading for around $198.92. These little legs here, that's where it traded outside or above the open and below the close throughout the day. So this is the range where the stock traded throughout this day, August 5th. If you were buying and selling, you would have bought within this range. The price of a stock goes up and down depending on how many people want to buy the stock or want to sell the stock. For example, here you see that more people wanted to sell the stock, and as a result, the stock went down. But then over the next several weeks, more people were interested in buying it, so the stock went up. The price of the stock or where it's currently being bought and sold at is based on how many buyers and sellers there are. It's a simple situation of supply and demand. If there's more demand for a stock or more people want to buy the stock, the price goes up. If more people want to sell the stock than are buying it, the price will go down. Let's now talk about earnings. Because if we're buying a piece of a company, we want it to be making money if at all possible. In this top left corner here, you see Apple's earnings per share. And this is broken down by per year. If a company does well and is continually making money and making more and more money, then over the long run, its stock price will tend to also go up. Now, there are some exceptions, for example, when a company is overvalued, but we won't worry about that right now. Just keep in mind that when a company's earnings are growing, there's typically more demand for that stock because more people want to own it, because there's the opportunity to make more money. On the other hand, if their earnings are declining, then less people will typically want to own the stock, so usually the stock price will be declining. Notice what's happened here with Apple's earnings over the past 10 years. Overall, we see nice, steady, consistent growth in its earnings. But what's happened to its stock price during that time? Here you see a chart of Apple's stock price during that same 10-year period. Each one of these candlesticks is the equivalent of 1 month worth of price action. Notice as a result of Apple's earnings going up consistently over time, its stock price has also gone up consistently over that time. In fact, it's up almost 800% over the past 10 years. People really like a company whose earnings are consistently growing like Apple's. How can you as an investor make money by owning a piece of a company like Apple? Well, there's two easy ways to make money on Apple. Number one is if the stock price goes up, you benefit from that stock price appreciation. Here you see an account where I just own 1 share of Apple. It's a very tiny percent ownership in Apple. Notice I bought this share about 1.5 years ago. And notice what's happened over that past 1.5 years. Well, overall, as you see here, the price of Apple has gone up 53.24% during that time. So one way to profit from a company like Apple is if you buy it at a good price, then the price continues to go up, well, you benefit from that stock price appreciation. Another way you can benefit or make money by owning shares in a company is if they pay their investors a dividend. Again, here we see the example of Apple, and it currently is paying a dividend of 0.44% per year. Now that's a really low dividend, but it does give its owner 25 cents per share for each quarter that they own the shares. So as an owner of companies like Apple, you can make money if the share price goes up and also if the company pays out a dividend. Now there are other ways to make money on shares you own, but that's a subject for another video. So how does a company make money? How does it make money for its investors? Well, as you see here in the top right, one thing you want to consider is a company's free cash flow. I've highlighted for you here what that means. It's the amount of money a company has left over after it's paid all of its bills and invested money to continue growing the company. So here you see with Apple, it's free cash flow per share over the past 10 years. And again, we see that over the long run, its free cash flow per share that you own has really gone up nicely. This is one reason why Apple pays a dividend, because it has so much extra cash sitting in its bank accounts. We talked about something called dividends. I want to clarify something when it comes to dividends. Some people get confused with the difference between a dividend and receiving interest from a company. You see, when you own shares of a company, you're not giving it a loan. You actually are an owner in that company. And the dividend is kind of like how they pay their owners a paycheck. That's different than if you loan the company money. If you loan the company money, then you'd be receiving interest. Because you own shares in the company, you haven't given them a loan, you actually are one of the owners. And a dividend is the way that they pay their owners. So that covers all the basics you need to know to begin considering investing in the stock market. But what exactly do you need to actually become an owner in these great companies like Apple? Well, the first thing you need is cash. You have to invest your cash as an investor in a company like Apple. And this shouldn't be cash you plan on needing in the next 6 months or a year or two. This should be cash you want to set aside as a long-term investment in a great company like Apple. When I buy shares of a company, I like to look at it as a long-term investment, an investment I plan to stay in for at least 10 years. Now, I may not stay in it for that long, but mentally, that's the mindset I have when I buy shares of a company. It is not money that I need to pay bills next month or 2 or 3 months from now. It's money I plan to keep invested for a long time if needed. And one reason for that is, as you see here, it gives the company time to grow its earnings. That earnings growth should produce a higher stock price, which is one way that you can make money by being an owner in a company. Another big decision you have to make when you're looking to invest in the stock market is, do you do it on your own or do you pay a financial advisor to do it for you? Now, if you had zero time and zero desire to learn about companies, then you might want to pick a financial advisor. Or you might do something that's even less expensive, which is buy a very small piece of all the 500 largest companies in the US. Here you see a ticker symbol for that exact situation. It's called SPY, otherwise known as SPDR. If you buy this ETF, which is kind of like a stock, it's a way of buying a piece of all the 500 largest companies in the US. Here you see the details on that ETF. ETF simply stands for Exchange Traded Funds. So as you see here, for $560.11, which is what SPY is currently trading for, you can buy a small piece of all 500 largest companies in the US. And here's another ETF that does the exact same thing. And I actually like this one just a little bit better. Its ticker symbol is VOO. It's the Vanguard S&P 500 ETF. I like it a little bit better than SPY because it charges you a lower fee than SPY does. So if you want simple, easy, and don't want to deal with getting to know all these companies, well, you might consider just buying a piece of all of them by buying some VOO or SPY. However, if you're okay with spending a little time to get to know some of these companies, to get to know your investments and learn how to watch over your investments like I do, then you can actually buy them on your own. And here you see an example of me buying some shares on my own. I have a lot of different investments, but one way I invest my money is by buying shares, a little piece of ownership in companies that I believe are undervalued or selling too cheap. And here you see an example of that. I share my patrons the stocks I bought on August 6th. Here I bought about 20 different companies, a little piece of ownership in all 20 of these companies that I believed were currently undervalued or had great potential to grow over the next years. Personally, I like to buy these shares once or twice a month. So every month I'm growing this portfolio of stocks that I believe are potentially undervalued and have set me up to benefit as an investor in these companies if the stock price appreciates. If they pay a dividend, well, I'll also get a dividend from those companies. Another question I get asked a lot is, how do you deal with losses? Well, as an investor, losses are just going to happen, but you can minimize those losses by thoroughly understanding what the company does and understanding if it's a profitable company or not, understanding how well the management runs the business, understanding what it should be trading for, that way you can buy it when it's discounted, like you see I did here. But just keep in mind that you won't get them all 100% right. You just don't know all the information, but you can know quite a bit about a company if you spend a little bit of time researching them. One of the big challenges and problems I see with investors is dealing with situations where there's a stock market crash. Human nature might be to run from those situations. But actually, as an investor, if you're picking solid companies that are consistently profitable, have a nice track record of dealing with challenging situations, when the stock market crashes, that's actually the best time to buy. So as people get out of the stock market when it's crashing, actually as a long-term investor that's looking to invest for years, that's actually when you want to buy. For example, note this date here. This is August 6th. Notice what happened in the stock market on this date. This last candlestick is the date that I bought those shares, August 6th. Notice what happened over the previous week in the overall market. It declined almost 10% during that time. I knew because of that decline, the companies I was buying that I believe were already undervalued, I knew it was a good time to add some shares or my ownership in those potentially undervalued companies. And now I fast forward to several weeks later, you see the stock market has recovered. Now sometimes it will take longer for the stock market to recover, but just keep in mind that when the stock market declines, if you're buying solid, consistently profitable companies, that can actually be the best time to buy those companies. The problem is controlling your emotion. And here you see what's kind of like a gauge of the emotions of fear and greed in the market. This is the VIX, or what's known as the volatility index. It shows you the amount of fear that's in the market. And as I zoom in here, this red candlestick here, that's August 6th. That's when I bought those shares. Notice that when the market declined those previous days, the volatility, the VIX, or fear, it spiked way up. It went up over 300%. But still, as a long-term investor, I knew it was an opportunity, and that's why I bought those shares, as you saw earlier. There is one other thing I want you to consider if you're ready to begin investing in companies, because it might just blow away any investment you could possibly make in shares or in companies. And that's if you have high interest credit cards and they're running balances, consider paying those off before you begin to buy shares in a company. Why is that? Well, here you see an example of some of the interest rates that some popular credit card companies are charging. See, American Express, they're charging almost 30%. Capital One, about the same. Discover, 28.24%. And Chase, 29.49% a year. Now, I'm going to tell you, if I had investments that made me that consistently, I'd put every penny I had in those investments. So if you have high interest credit cards like this, well, please consider paying those credit cards off before you begin investing in the stock market. Over the long term, the stock market does not produce this high of a return. Now, on certain occasions, it can, but over the long term, it's a lot lower than what these high interest credit cards are charging people who owe them money. So please pay off high interest debt first before you begin investing in shares of companies. So where do you actually go to buy and sell your ownership in these companies? Here's a list of some of the more popular brokers you can use to buy and sell your shares. You want to open an account up with the broker you choose. I'd encourage you to do a little more research on these brokers, but I can mention a few that I've used over the years. One that I've used for a long time, and mainly for my option trading, which is a subject for another video, and I have a lot of videos about option trading on this channel, but one that I use and I like a lot is Interactive Brokers. They're consistently profitable. I've never had a problem making trades with them, so I like them. I also traded a lot with E-Trade. They're a little more beginner friendly. Interactive Brokers is more for a professional trader. So if you're starting out, you might want to consider E-Trade. There's also others that are very popular, including Tasty Trade, Robinhood, Webull, Vanguard, and TradeStation. Personally, I've also traded with TradeStation. I do have a small account with Webull. But if I were picking the company that I was looking to open an account with, I'd probably pick E-Trade, Interactive Brokers, or TradeStation. And another very popular one I've never had an account with, but I've heard a lot of good things about, is Fidelity. So those are a few that you might want to consider, and just do your own research. Look at reviews on these different brokerages before you open an account with them. You're trusting them with your cash, and they'll be holding the shares you buy in your favorite companies. So spend a little time getting to know them. So how do you pick the companies you invest in or you become a percent owner in? Well, one thing I encourage people to do is to invest in companies that they're familiar with. Here you see one that probably most of us are familiar with. Its ticker symbol is MET. You might even have an account with them. Another popular one is JP Morgan Bank. You've probably heard of them. Then we have others like Oracle. Then we also have AbbVie, which sells medication. Then one that probably everyone in the world is familiar with, Google. So I encourage you at first, maybe just invest in companies that you're very familiar with. Hopefully you even use their products and you like how the company runs. But in addition to it being well run, if you can invest in a company that kind of has a moat or offers a product or service that's hard to replicate, that's even better. And one company that probably comes to mind when you think about that is Google. For example, if you're searching for something on the internet, people normally say, I'm going to Google that. That's a company that has a moat. The service they offer is very hard to replicate. That's one reason why Google or its owner Alphabet has done so well. Another thing to consider is how well management has done. For example, here you see a couple other metrics on a website called Simply Safe Dividends. It kind of helps you to assess how management has performed over the past 10 years. We have the return on equity and return on invested capital. You're an investor. You should be concerned with how much return you should expect on your capital. So these are two metrics you want to consider when you're looking to see what the track record is of its current management and how well the company is being run. Another nice website you could consider to help you do your research is Seeking Alpha. They offer a lot of metrics that you can look at to kind of grade or rate how the managers have done. And if you'd like a free trial to try out Seeking Alpha, I'll leave a link to it down in the description of this video. Another metric I like to look at, and I like to look at it over more than just a 5-year time frame, but that metric is price to earnings. How much does a company typically sell for the amount of earnings that they're realizing? Here you see a simple chart of the past 5 years, the price to earnings of Apple. This is currently trading for around 31.3 price to earnings. Now, when will be a good time to buy this? Well, obviously, if you could buy it down here, when it's trading for a lower price to earnings, you're getting a better deal. So right now, over the past 5 years, it's trading for above its average. Personally, I like to buy companies that are trading well below their average on price to earnings, not just on a 5-year time frame, but also on a 10, 15, 20, and even the max life of the time frame. Looking at price to earnings, what it's currently trading for, and what the average is over the previous years is one way to know if you're possibly buying a good or undervalued company. If investing in companies is something that you want to do, but you're a little nervous about it, why not consider paper trading? Open up a paper trade or an imitation account and just trade for a while to see how the stock prices move around on your favorite companies. That will enable you to get a level of comfort before you actually put your hard-earned money to work. But one thing I strongly encourage you to do before you make any investment is to just spend time educating yourself. I have hundreds of videos on my YouTube channel you can watch, and they're all for free to help you to become a better stock and option trader. So please spend some time educating yourself on what are the best companies to buy. That'll enable you to make smart investments in companies that have a high probability of making you, the investor, the owner, nice profits over the coming years. So to recap, the important things you need to consider as an owner in companies is, number one, make sure that you only invest or buy companies that you understand. If you don't understand them yet, spend a lot of time getting to know the company before you invest in it. Number two, try and pick companies that have an economic moat. It's hard to replicate the service or product that they sell. Number three, make sure the management is solid and consistent. You can see that in how their earnings grow. If their earnings are all over the place, well, they're not really that consistent. And do you really want to invest in a company that has management that's not consistent? I don't. And then number four, try and only buy these companies when they're selling at a discount. They're selling cheaper than they normally do over their recent history. If you do those four things, you'll find that over the long term, you'll be a successful owner in a lot of great different companies. You'll have created something you can benefit from for the rest of your life. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. Collecting dividends and selling shares I've made a lot of money on are just two of the ways that I make money when I own shares in companies. Another way is by renting out my stock. If you'd like to see how you can rent out your stock to put consistent cash flow in your pocket every month, check out the video at the link above and description below entitled Covered Call Strategy, the best way to use covered calls. Until next time, happy investing, and we'll see you again soon.